All of a sudden I hear this commotion going on, and the police officer's like telling the guy, like, "No, sir, I'm not going to help you put your pants on," or whatever. I didn't know what was going on, but there had been a warrant out for this guy's arrest.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 44. My guest today is Andy Wierda, the owner of MC Equity Partners and a local investor here in the Grand Rapids area. So today, Andy and I are going to talk about owning and managing single-family rentals, buying and flipping foreclosures, rehabbing, and among many other things, we're going to talk about the epiphany that he had one day while buying a drink at a convenience store and how that moment changed his investing career forever. So Andy, thanks so much for being on the show today.
Thanks for having me.
Why don't you tell me a little bit about yourself and how you got into real estate investing in the first place?
Sure. Well, the property I bought in 2002, that was unlike anything I started doing later in 2008 when we started having a lot of foreclosures. And in 2002, I basically purchased a property on Power Street in the northwest side of Grand Rapids for, I believe it was $99,000, which in retrospect was quite high, considering that in 2008, I bought another house a block away for $17,000. But that was the market then, and I was getting outbid on other houses, so I ended up putting down this money on this property, and it was kind of I had a weird situation there, because on the one hand I had the best tenant I've ever had, and on the other hand I had the worst. I had one guy who's lived there for 50 years, still lives there today, has been there the whole time since I've owned it, since 2002. The other tenant was a constant struggle to collect from, kept the property very dirty. I don't know if the former owner paid them when I went and viewed it, because it was in great shape when I went and viewed it, and it never looked that clean again. But so that, anyways, after having to ultimately evict the tenant in the lower unit, the bad tenant, it just kind of cooled me off a little bit on trying to acquire more properties, which in hindsight was very lucky, because had I bought throughout that period, I would have numerous properties that were underwater once we got to 2008 and 2009. So I really didn't do anything until about 2008, and that's where the starting gun. Yeah, that's where the so-called epiphany kind of happened. Yep.
Yeah. Well, let's talk about that 2002 duplex that you bought. You were basically dipping your toes in the water. You wanted to see if real estate investing was for you. Is that
well? And at the time, and again in my lifetime, so I'm 38, but real estate prices had never really gone down. I mean, I was born in '78, and that was probably one of the worst times for real estate prices, but I had never seen anything go down. So it just felt like prices were continually going up. And also at that point, interest rates were like 6.25%, which seems high now, but that was really low. I mean, when I first bought my first personal residence, I think my interest rate was about 8.5 in like 2000. Well, yeah, right around 2001, 2000. And then it started dropping and going down. So I'm like, I kind of wanted to lock something in while interest rates were that low, or so I thought at the time, which was dumb. But that was part of the thought. I'm like, I got to lock something in while it's low. These prices are never going down. I felt like I missed the boat already. I felt like prices would never be where they ultimately ended up coming down to. So yeah, I was kind of trying to get the ball rolling, but then it just, it was a little harder than I thought once I purchased it.
Well, what were the economics? Because if you bought in 2002, this was pre-bubble. I mean, the bubble was maybe
Correct.
Just beginning, just forming. So, if you were buying on cash flow, this sounds like a property that still could have made sense.
Yeah, it barely made sense. I think I put $25,000 down. So I had a loan balance of around $75,000, but really, I think it was bringing in about $1,100 a month at the time. And when you look at that versus the mortgage payment, it was good. But then when you really factor in, if you really start budgeting for the capital expenditures you need to, and all the other stuff, I mean, if everything went well, I was maybe clearing $3,000 a year. But if it doesn't, or if you got to replace that roof or put on a new front deck or whatever, it eats up it ate up the cash flow pretty quick. I wasn't getting rich off it, but I wasn't losing money either. But then when I went to evict the first tenant, all of a sudden I'm looking at like a $10,000 rehab because the place was a mess. So if you pocket a few thousand a year, you think you're getting ahead, but then all of a sudden it comes time to pay up when something like that happens. So,
and were you managing yourself?
I was managing myself.
And were you doing a lot of the rehab yourself?
I would do some. I tried to start doing some of the rehab, but I'm not the quickest at that type of work. And eventually, just trying to do that on nights and weekends, it just didn't work out. So I started finding contractors. But that one I really only had to rehab one time. After I got rid of, that was a one-time deal. And then once I fixed it up, I actually just let a buddy live there for below market rate rent for a while, just because I didn't feel like going through the same disaster I just had. And really since then, he moved out eventually, but it's been fine. I really haven't had to do any major renovations to that. I still hold that property. It still might be, it's maybe worth $99,000. It's getting close. It's maybe not quite there, but.
Oh, so you're back to where, so even with the bubble and the bounce back from the Great Recession, you're just now back to maybe where you were in 2002.
Yeah, I haven't put any of my 2 units up for sale, but I'm guessing a lot of them are going to sell in the mid 80s right now.
Is it because of the neighborhood, the area that it's in?
The neighborhood, the area, the rents, yeah. But like I said, I was picking up other 2 units in that area in 2008 to 2010 for, as low as $8,000, 15, 20, just ridiculously cheap. The 2 units especially were going very cheap then because
that's pennies on the dollar.
It was pennies on the dollar, yeah, right. So like I said, in the one way, I was fortunate I didn't try to buy more. Through that period, I just kind of lucked out. My life went in some different directions, and I really wasn't focused on the real estate. And so I missed out on buying into a lot of the bubble, and then kind of came back after the bubble burst. So
yeah, it's funny. Looking back, I remember it was probably between 2010, 2011. There were so many duplexes on the market that you could pick up for $20,000, $30,000. And these were duplexes that now would sell for over $100,000. So if I had a crystal ball and understood that, you have these demographics like the millennials who would want to be house hacking, living in one side and renting out the other side, I would have bought them all up.
Yes.
And I'd be retired by now.
No, I regret that I didn't buy more 2 units because financing was tough on investment properties anyways, but on the 2 units, it was even more challenging. There was a lot of good deals on 4 units at that time too. But I didn't necessarily, I don't know. I didn't know if people were going to jump back into wanting to own investment properties because at that time when the bubble burst, everybody was pretty sour on real estate. And I knew with the single families, I could ultimately sell those to an end user, like a family buying their first home. With the investment properties, I didn't know if they were going to shoot back up the way they did, but they did. And I wish I would have bought.
Yeah, there's no way to know till after the fact. And your crystal ball said single families, that's the way to go because you figured they'd be more liquid and there'd be more people wanting to buy them.
I could figure I'd sell them ultimately to an end user instead of an investor, whereas investors usually putting the pencil to the paper, making sure all the numbers work out. With the end user, sometimes you have a family or a person that just falls in love with a home and wants to buy it for whatever reason. So I felt that was my idea. Whether that entirely plays out, we'll see. It has to some extent in the last year or so. But
yeah, it sounds solid.
Yeah.
So let's go back to the duplex in 2002. It sounds like you were getting $1,100 a month, and that's just gross. Your rent income. So you're probably renting out $500-$600 somewhere in there. That was your rent.
Yep, I think one unit was $550 and the other was $535.
Okay. And were these 2 bedrooms?
They were both 2-bedroom units. Yes.
Okay.
Yep.
So rents have definitely gone up. They have. What are you getting now?
Well, so the one guy still lives there, and since he's one of my first tenants, they tried to bump him up to $570. I said, no, you got to put him back at $535, just because I don't know. He's just been great.
You like him.
I like. Yeah. It's kind of and so. But otherwise, I believe the lower unit's $650, and I have some other comparable ones that are now closer to $700. And really, for my properties, the rents really in the last 2 to 3 years have really shot up dramatically. earlier in 2008 through 2010, I would still say I was close to 550 on a lot of my 2-bedroom duplexes. And again, most of these aren't Class A properties. They're probably not Class B. They're maybe more Class C, depending how you categorize them. But yeah, the last year or two, the rents have just shot up dramatically. So
you kind of dipped your toes in the water. You bought that duplex in 2002, and then you didn't buy anything till 2008.
Correct.
Was that a conscious decision? Just I'm not sure I want to keep doing this, or what was it? What was going on between 2002 2008 that kept you from buying more?
Sure. Yeah, I think part of it I run a truck parts company with my dad and my brother, and I started taking some ownership in that. We actually ended up doing a commercial deal where we bought a building that we had been leasing, which ended up being very beneficial to me later as far as rounding up money to buy more residential rentals in Grand Rapids. But so I just had other focuses going on. And like I think I had maybe mentioned before, I had just gotten divorced in 2008. So, there was some stuff. I just had a lot of different things going on in my life, and real estate wasn't really the focus. And then, after I got divorced, I kind of just started looking around again and decided I was going to make a run at real estate. And, so it's kind of a moment. I didn't really have a whole lot to lose, and I didn't have to run it by anybody. I think, especially for people starting out the first time, you're buying your first house or your second house. If your spouse isn't on board, that can be a little nerve-wracking, I think, which I'm sure a lot of first-time investors run into. And generally, your first investments aren't your best ones. I think I've listened to other people on your show here too, and no matter who it is, a lot of times your first ones are never the greatest.
Yeah.
That's kind of the one that people are judging you on, like, does he really know what he's doing or not? So I just was I had totally lost track of how cheap properties got in Grand Rapids. I was astonished when I came back into the market
in 2008.
Yeah.
So before we get to 2008, you said something about buying the commercial property that you were previously leasing for your trucking company. And that helped you acquire loans later on. Talk about what's the story there with the commercial property?
Well, it was a tale of how different commercial. So I'd never done anything with commercial banking before, and to make a long story short, we had a building that was across the street from our main warehouse, and we were paying roughly $100,000 a year in rent on this building. And we were in kind of a bad lease.
How many square feet did you have?
It was about 30 to 35,000 square feet.
Okay, so this is sizable.
It was sizable, but it's a building that's landlocked, doesn't have much value to anybody except us, and we were paying a rate similar to what we could have got a Class A property for at that time. Because especially in Michigan, even in 2005 and 2006, the housing market hadn't crashed, but there was a lot of open warehouse space. Manufacturing was somewhat down. I think Michigan kind of hit the recession a little bit before a lot of other states did.
Yeah, we were feeling it probably 3 or 4 years earlier.
Where you had net outflows, our population wasn't increasing. But anyways, so finally I agreed to get this guy to sell me this building for $675,000. And I don't think it's worth more than $500,000, but we also are on the hook for a couple $100,000 of lease payments to him yet. So we strike this deal, and then I'm looking for somebody to finance it. And I had 3 banks all offer me no money down financing just based on the strength of our core business, and they felt that we would be able to pay it off. And then ultimately I ended up going with the Bank of Holland, and they came in, and the appraisal came in at $495, right?
So that's too low because you had it under contract for what?
$675.
$675,
right? But I'm still looking at I'm going to owe this guy a couple $100,000 in payments anyways. But it didn't matter. They still did the deal, and I think at that time I went to it was Bank of Holland, it was Huntington, and it was West Michigan Community Bank, and all 3 of them were still willing to do the deal, no money down, even with that appraisal. But this is in 2000.
So they were going to loan you more than what the appraisal.
Exactly. But this is what, and they're all trying to undercut each other and all wondering why they didn't get the deal. And this is 2005, but this was
2005.
2005.
Oh, okay.
Yeah. So I'm naively thinking this is great. This commercial lending thing is great, because then to make it even better, I had locked a rate in at 6.25%. Because they said you can either let it float which floating it probably would have been around 5.25, 5.5. But then if interest rates go up, my commercial loan's going up. If they go down, it's going down. And all of a sudden, so I'm like, I always kind of want to know what my payment is, so I lock that in. And then lo and behold, the economy keeps getting worse, and the Fed just starts cutting rates. And I'm looking at this thing like, man, if I would have floated this, I'd be down in like the 4s by now. And instead, I'm here at 6.25. But as with most commercial loans, there's a prepayment penalty on it. Like it was going to be like $10,000 or $12,000. Well, I'm running the numbers, and it almost makes sense to do this. But then the Bank of Holland came back to me, and they're like, well, we'll tell you what, if you bring all your business over here, all your deposit business, everything else, we'll rip that loan up like it didn't happen and put in place a $675,000 floating loan, which eventually got down to the floor of 4% and has really been there for the majority of the last,
wow,
8 years. And so I'm like, hey, again, this commercial lending is great. Like, I kind of screwed up. They just ripped this up. We do this again. It was just so easy, and everybody's looking for business at that time. So
yeah, it's a different world when you're
it's
borrowing commercial property.
Way different world. It's more of, again, if you know a guy, if you know somebody or a guy or a lady that's willing to kind of fight for your project or get your project, pushed in front of people, it can really go a long way. It's more of a handshake type of deal than when you go get a personal mortgage where you get to come in with 30 different pieces of documentation and this and that.
Yeah. Well, when you're getting that residential loan, there's so many government regulations and boxes that need to be checked.
Right.
The commercial world has regulations and boxes that need to be checked, but it's not nearly as many as the residential loan.
Sure. Yeah, for sure.
Yeah. However, they did tighten up quite a bit once the recession happened.
They did. It totally turned from certain banks just not commercially willing to lend on real estate at all. And even the ones that did, I had to really, kind of go in and do a dog and pony show or whatever you want to say. Like I had to really demonstrate what I was doing. I was still getting rejected. It definitely got much tighter, but that alignment with the Bank of Holland really helped because they were in a strong position to lend. They didn't have a ton of bad loans on the books. And so by the time 2008 hit, I had a pretty strong relationship with them, and they really helped me get going until they told me that they had enough of my business and didn't, they only feel comfortable at a certain point.
Yeah, the smaller banks, they do max out at some point.
Right. Not everybody thought it was as great of an idea as I did. I'm like, we can't miss. This is, a home run. But I had to get more creative after that. But they definitely, that was huge getting aligned with them. Because prior to that, I had been aligned a lot with Macatawa Bank, and then eventually I started buying some of Macatawa's properties, but they really couldn't lend me any money for new real estate ventures at that time. It got to the point where some banks, I think even West Michigan Community was one, where they almost had a cease and desist order as far as not being able to lend more on real estate because their loan portfolio was over allocated that way already.
Yeah.
But they've come back. I actually own a little bit of West Michigan Community Bank now, so I can put in a plug for them later.
Okay. But you're one of the stockholders?
I am. Yeah, my lenders that I dealt with a lot at the Bank of Holland actually ended up eventually just moving over. After the Bank of Holland got bought out by Chemical, they moved over there last year. So they've come back around nicely. But yeah, it was different. A lot of banks were really, really tied as far as what they could do.
Yeah. Oh, absolutely. And with good reason. The world was ending.
Right, that's what it felt like, right?
So 2008, that's when things changed for you.
Yep.
And you got back in the game. What happened in 2008 that made you start investing again? Sure.
Well, originally I had some cash, and I was going to try to do some flips. And I bought a house in Zeeland, but the market for flipping was starting to change too because, the majority of people that are selling houses at $100,000 or less, it's generally going to be an FHA loan. Well, the FHA loan, it used to be not only did you only have to bring in 3% down, but it got to the point where you were able to obtain that 3% in various different ways. It could be from a family member giving you the money. I think there was weird scenarios where somehow the seller could almost funnel it back to the buyer to help with the down payment. Well, they really tightened all that up. And that was tightening up the market for reselling these flips. And I didn't have a lot of experience with it anyways. So I'm like, all right, maybe this isn't going to work. And plus, in the nicer areas, you get a Hudsonville, Zeeland, which used to be suburbs of Grand Rapids. you got to have a lot more invested. I mean, I would probably have to invest $100,000 in a property in Hudsonville or Zeeland to get the same amount of rent that you would get at the time for like a $30,000 in a rough part of Grand Rapids, or rougher part of Grand Rapids.
So you could buy in a rougher part of Grand Rapids
and get about the same rent
for $30,000. Get the same rent as you would further out in more
suburb, right?
More, the suburbs or more rural.
Yeah,
it's hard to say that word. Right. Rural areas.
Yeah, for sure.
Yeah, okay, that makes sense.
Around that time, at least. Mm-hmm. Now, I mean, now since then, the rents have shot up a lot in those areas too. But yeah, so I just started looking at properties in Grand Rapids, and I was amazed at how cheap some of them were. So I just kind of picked one out, and it was on 813 Madison, which was near Madison and Franklin. And I went down and I saw this thing, and I was amazed how good it looked. It needed some work, but like going back to when I bought that first property in 2001 or 2002 or whatever it was, I had gone through a lot of different properties before purchasing it, and I was amazed at how nasty some of them were, quite honestly. And they're occupied, like people are living in them, and they're just dumps. So you kind of get an idea of what people live in, what they're willing to live in. And then I get to this house on Madison, and I believe it had been redone about 10 years earlier by the Inner City Christian Foundation, where they had stripped it all the way down to the studs. So it was a little dirty, needed some cleaning, needed some carpet. But literally, I think I maybe had $1,500 into getting it up and running. And
are you gonna tell your story?
Yeah. So
this is the moment to change everything for you, right?
So I go, I'm like looking at this thing and trying to figure this out and trying to figure out why this wouldn't be a good idea to buy it. And I go next. There's a party store 2 doors down, and I'm gonna go grab some beer there. And I get there, and the cashier's kind of, she's like, "What are you doing in this neighborhood?" type of thing. And I'm like, "Well, I'm going to buy that house, right next door." She's like, "Really? You're going to buy that house?" She's like, "I got Section 8. I'll give you $850 a month for it." And I'm like, "Really? Like $850 a month for, 30? I think I bought it for $29,900 or something like that. So I'm thinking $850 a month on $30,000. Like, this is awesome, And then, and it did work out. I mean, she had Section 8. I think we eventually had to come down to like $830 or something like that. And the Section 8 inspector came through, and I had to do maybe 5 or 6 fixes. She moves in. We're good to go. Again, and in hindsight, that's not the best way to find your tenant, probably, because she ended up causing problems for me down the road, which helped destroy my personal credit. But that's another story. But but it worked out, because going in, I didn't know how easy it would be to get renters. Even I would say to like my first 10 properties, I really wasn't sure if I had 10 properties, if 5 of them would be sitting vacant. Or just that, you hear that generally everybody's like a 90% rule for occupancy, but until you get in there and do it and get a feel for how hard it is to fill properties, you don't really know. But yeah, starting out, just all I could think about was, all right, so I put $30,000 down, I get $850 a month. Like, if I can repeat this process over and over, it's got to work. And that's when I really got focused, basically in Grand Rapids and Wyoming primarily, and just kind of looked at it like a land rush and tried to buy up as much as I could.
So that's what you did. You bought up a bunch of single families.
Yep.
You were doing the rehab?
Yep, I was doing the rehab, and at first I had a couple realtors who worked with me, and they were going to try to line up contractors too. But the first rehab budget they gave me, one of them was like $25,000 or something. I'm like, there's no way I'm putting 20. I bought a property for like 20. I'm like, I'm not putting $25,000 into it. But they were coming off a time period where other investors, there was some mortgage fraud that had been going on in Grand Rapids for sure. And you get other investors, say in 05, 06, who are buying properties and maybe putting $25,000 into them, getting the thing reappraised and taking a huge amount of cash out. And maybe they're filling the property, maybe they're not. And then eventually they're walking away from the property. So the whole, as far as what people were quoting on jobs, was drastically different. They were based on a time when times were good,
right?
But I'm like, in 2008, what really happened was there were so many people out of work around here that I just started finding my own guys and paying them hourly, and basically kind of became the contractor. And so, when I say I did rehab a lot of properties, but my average rehab is probably between anywhere from $2,000 to $10,000. I'm not.
What were you doing? How were you making these houses better?
Basically just doing whatever I needed to make it safe and make it clean and make it rentable. So a lot of times it was repainting everything and putting in new carpet and then handling any major mechanical issues. I mean, some of them I bought properties where the furnace and hot water heater have been stolen. The copper has been stolen out of the basement.
You're going to a lot of properties at that time where everything had been stripped.
Yes,
like,
but
holes had been put in walls and all the copper had been pulled out.
Right, exactly. But in hindsight, I mean, some of that actually helped because some of them were in such bad shape, or some of them would have like, you could tell they had animals that were maybe peeing all over the place or whatever, like really disgusting houses, but really better for me because the more disgusting they were, it seemed like the more ready a lot of these were asset managers based in different parts of the country, but that were controlling these properties, but they're ready to just unload these things because they get the reports back and they know they're not good, which would help drive the price down that much lower. So that was, so it varied, but I would say the real sweet spot came, I would say around the end of 2009. Like I would do that deal on Madison again, but it was like houses kept getting cheaper. I was buying like in the 30s, and then next thing I know, they're in the 20s, and then all of a sudden they're in the high teens. But really, there was a period there where I could buy houses for between $15,000 to $20,000 and get them up and running with like $2,000, which was good in two ways because if it's only $2,000 rehab, that means we're getting them up and done quick. Like maybe 1 week, we got this thing up and running. I've bought, the cheapest house I ever bought was $4,000, right?
Wow.
But I probably had to put $15,000 into it. And next thing you know, that's 5 or 6 weeks and it's still not that great of a house, but it was $4,000. It just seemed, how can you pass that up? Right. But
yeah. So you bought quite a few of these.
I did. I probably bought, I've probably bought about 100. And I had a partner at one point, and that ended badly. But I'd say the most we held at one point, I think we got into the high 80s. For some reason in my head, I made a goal of 100, no particular reason, just because it sounded, just looking back to when you're younger, it just sounded like a crazy idea to own 100 houses, I did get over 100 units, but I don't think I ever quite held 100 homes all at one time. But yeah, it was for 3 years. I mean, I went at it hard. So, yeah.
So let's talk about the good and the bad of doing what you did, because I'm sure in a lot of ways it worked out great, but in other ways you probably wish you'd done it differently. So what are the good and the bad of that strategy?
Yeah, well, I probably would have linked up with a property management company sooner. When I first started buying, you hear horror stories from other investors sometimes about property management companies, and I didn't want to get linked up with a bad one that was going to ruin my whole plan or my whole deal. So I did all the management. And then eventually I hired, there was a guy that he worked for me, and eventually his wife came on, and we all pretty much worked full time, managing the properties and managing the rehabs. But we got in over our head, and I wasn't as good at screening people. I was terrible in the beginning. I mean, some of these houses were buying for like $15,000, right? So if somebody comes in with, deposit and first month's rent, let's say the rent's $750, deposit $750, I got $1,500. Like I'm kind of just willing to give people a shot.
So you didn't even do a background check? Is that
no. Okay. Which because like you think like, well,
if they have that kind of money, they must be.
Yeah, they have that kind of money. Although during that time, part of the reason some of them had that kind of money, and I can touch on, I had a couple really good deals that worked out, but a lot of these people, there's a lot of tenant movement then because a lot of people were getting evicted from homes because the owner of the home was losing it to foreclosure.
Oh, okay.
So they're literally getting cash for keys, where they might be getting offered $1,500 or whatever to get out, as opposed to staying in there and then lengthening out the process of the foreclosure for the lender. I was bad at. We just let people in, and I still have a few tenants that were originals, but my turnover rate was way higher than what Compass's was. And you think you're saving yourself time on the front end, but then it just catches you on the back end, because if I'm living in, I lived about 25 minutes away from where all these properties were. So if I found somebody that thought was a decent prospect, I just want to kind of get this deal done so I can, because I'm moving on to the next thing, and I wanted to get these houses all filled up so that I could hold them all. But that was
So is that kind of how you got in over your head with the management part? Is just letting in the wrong tenants?
it didn't help. Yeah, I mean, it definitely made more work coming down the road. But the other thing, and I think maybe you don't realize this when you're first getting into it, but if people are looking to see properties, I would put properties up on Craigslist. I would get a huge response from that. But like for every, let's say, 10 scheduled appointments you have, probably only 5 of them really happen. Like people don't show up for whatever reason. So I'm driving in from further out of town. And when I get there, every once in a while I'd have it where it'd be a no-show. I just feel like I'm wasting time. So I tended to then just be like, somebody looked halfway decent, and I thought...
So the next person who shows up...
Yeah, and I thought I was a pretty good judge of people before I got into being a landlord. I knew some people were BSing me, but I thought I kind of knew what I was doing. But man, I swear some people could win an Oscar for some of the...
So give me an example. How did you misjudge some of the...
Well, you just, they tell you their life story, and they tell you this and that, and they tell you how great they're going to take care of the property, and they don't. And then, and it's funny too, because I don't know if you ever read anything by that Jeffrey Taylor, the Mr. Landlord.
Oh, Mr. Landlord. Yeah, he's going to be, by the way, let me just organic plug here for our annual conference in February. February 2017, he's going to be speaking at our conference.
Okay. Yeah.
He does a great job too.
He does. But in his some material I bought from one time, it said like things to look out for, and it's kind of funny because one of them said, if anybody leaves you a voicemail and ends it with "Have a blessed day," look out. And that's so true. Like I said the same thing before I even said it. It's like sometimes people take like a religious aspect or whatever, and like some of those people are the ones that come back and burn you the worst.
You mean if they love God and Jesus?
Well,
they're not awesome
No, I don't.
tenants?
No, yeah.
Come on, that's blasphemous.
Right.
Yeah.
So yeah, it just and then simple things I made mistakes on. Like I didn't make people give me their confirmation numbers that they had utilities change into their name before they moved in. And I should have, because then what happens is if they don't pay the bill, especially when I only had a couple properties that are still under my own personal name, so then I'm like, I'm not a pushover. I'm just put the bill in the mail and send it to them and be like, hey, I'm not going to pay this. You better pay it or your gas is going to get shut off or whatever. But since they didn't get it switched over, it's still under my name, right? So all of a sudden, if they don't pay the bill for 90 days, then you have the gas company or the electric company reporting to the credit bureau that they're not getting paid.
And you're the one who's on the bill.
And I'm the one that's on the bill. So it's only a matter of a few, like at one point, I know it's only a matter of a few $100s, but all of a sudden they're reporting and it's dinging my credit. Well, I had some credit cards, and I think you had talked about, anywhere from your Lowe's card to personal credit cards that I did a ton of stuff on, where I had some really high credit limits, like maybe $30,000 to $50,000 credit limits. And maybe I'd be using some of that credit. Well, then once my score got dinged, they didn't want me to have that much credit anymore. And so every time, if I had a card that had, let's say, a $40,000 balance on, I pay it down to 20, I would get a week later, they would reduce my credit limit right down to 20.
Oh, wow.
Yeah. And then it starts to spiral, because then it looks like you're always using up 90 or 100% of your total available credit. Mm-hmm. And there's no way to get out of it, because every time I pay it down, they reduce it down. So my ratio was always so high, and it all really started with me being stubborn. I should have just set the eviction process in motion, tried to get the tenant out for not getting utilities changed instead of taking the route that I did, because I didn't realize the damage it was going to do later on.
Yeah. Well, so the episode you're referring to is my interview with Ty Crandall, who talks about business credit and how the different bureaus and the people or the companies that extend credit to you look at your personal credit to determine what kind of limits they're going to give you. But it sounds like the lesson that people should be taking from what you experienced is don't keep the utilities in your name. Make sure that they get transferred to either the management company or the tenant themselves.
Correct. Or at least, and just start an LLC right away. Because as soon as you have the LLC, now, we wouldn't let people move in without confirmation now. I learned that in the first 6 months. But as long as you have an LLC set up, then you can get a commercial account with DTE, with Consumers Energy. So worst case scenario, something like that happens, it's not getting reported back in your personal credit score. And the same way, even if you can open some business credit cards, I realize they do, usually make you put your social security number down as a personal guarantee. However, if you can get business credit, it doesn't usually flow back on your personal credit history. So if you do start using large amounts of that credit and you're using 90% of your available commercial credit, it's not coming back and hurting your own your own personal credit score.
Yeah, good point. So you get confirmation from your tenants now. I mean, what kind of confirmation are you talking about?
Basically, they would get confirmation numbers from DTE or from Consumers Energy.
And you were requiring that confirmation before you would let them move into the property?
Correct. Now, they probably could have been entirely making them up, and we may not have known the difference, but it never had. Just by saying that, they would do it. They would usually do it and get us this number. And I don't know what system, like I said, I haven't personally managed them in 4 years.
Well, let's talk about that, because you were managing,
sure.
And like in your own words, you were in over your head to some extent. And I've seen this many times, people who manage their own properties, but aren't as good at it as professional third-party management companies.
Yeah.
Although I've seen plenty of people who are very good at it too. So at what point did you say, you know what, I don't want to, this is not turning out because I'm not managing the way I need to be. I'm going to turn it over. How did you come
It was
to
a
that
slow
conclusion?
process. I was a little stubborn. And part, I had a couple people working for me and I really didn't want to let them go. So that probably drug it out. But yeah, it just got to be overwhelming. The guy that was my main right-hand man. I mean, he never had a computer before he met me. Honest as the day is long, great guy. But the bookkeeping end of it was basically me or him trying to figure it out.
Using what?
We did a lot of
ledgers, or
well, he did, yeah. And then we convert a lot of it into spreadsheets, or we actually set up a system with QuickBooks eventually to try to. Some of it's handwritten, and that was the other thing. I mean, we did things so backwards. I mean, we collected so much cash in the beginning; it was crazy because I don't think a lot of people realize, but in a lot of your inner city neighborhoods, a lot of people are unbanked. And there's various reasons for that.
Oh, so they actually pay in cash.
Yeah. So if they're getting, even if they're getting a check, let's say whether there's government assistance or whatever it is every month, they're cashing that. And then if anything, even once we did start requiring no cash, the majority of what we got was money orders. I mean, out of let's say 50 properties, maybe 2 would be checks, the rest would be money orders. So they're actually going back down to the local party store and probably paying another $5 or $10 for the money order. But I had a guy in the area, so we would collect cash. But in hindsight, that's really dumb because.
So were you actually going door to door and collecting cash?
For the people, if they wanted, if they said, "Hey, I got the cash, I'll come pick it up." But on any given day, my guy might be rolling around with $5,000 or $6,000 or whatever, and obviously, if people kind of start knowing your route, that gets a little dangerous.
Did you ever run into trouble?
We didn't. We didn't. But a little bit of it goes back to, I know Allison Kutzier kind of talked about training your tenant, and it's just a bad habit to get your tenants into, because not only do you not want to be rolling around with that much cash, but it also, sometimes you'll show up and they owe you $800 and they'll have $550 or something, and it just creates a lot of time. And, but in the beginning I was so determined. I'm like, I'm going to get this rent. These places aren't going to go vacant. I would just do whatever. I mean, I would go pick tenants up from where they were living to go show them my properties.
Wow.
And I just was going to do it. And, but yeah, so there was things like that. It's not sustainable over, as you start scaling up and getting more properties, it just wasn't sustainable anymore. And I was handling the properties is one thing, but then when you get them all filled, then you got that many people on top of it. And that's when it really became, a battle and a lot of work. So
how did you go about finding a management company that you could trust?
Yep. So I bought this apartment building, which I think was one discussed earlier, on Taft in Wyoming. And at the time I bought it, Compass Property Management was managing the building for the bank. So when I bought that building, I left them in place to manage that. So that was where my first relationship really started with them. So then I got a pretty good feel out, and there were some growing pains for sure in the beginning. And there has been. It's been a little bit of a work in progress, but we have a great relationship now. And so I got to know them from that. And then eventually, a partner and I were going to split, and we didn't have a whole lot of trust of each other. So he wanted a third party to manage the mutual properties that we had together. And I think at that time I maybe had 50 properties of my own, and we maybe had like 37 together. So all the properties that we held jointly, we moved over to Compass to manage while we were trying to sort out our affairs and decide how we were going to divvy things up. So then it grew that much more with Compass. And then I finally called, Mark Troy up, and I said, hey, if I bring the rest of my portfolio over, what can we do as far as, management rate and stuff like that? And we can hammer out a deal, because it just got, once I started seeing the reports they can generate, the bookkeeping they can do. They have somebody on call all the time.
They have leasing agents.
Handle
right. All the showings and the background checks and everything.
Exactly. And then as time went on, they did a better job of getting me higher rents. They create a little bit of an intermediary between you and the tenant. I was pretty bad. Like some people, if everything was going good and if I was making good money and life was good, I really struggled raising their rent $50 or $100 because I knew that it was a lot to them. And even setting market rate rents when a place came available again, just over time they were able to get me more rent where they really paid for themselves in a lot of ways. And it just, again, it gives you a little separation between you and the tenant. Not that I would get overly involved in anybody's personal business, but as a landlord, I mean, you will hear so many stories, and it's hard to totally separate yourself from that.
Well, what's the best story you ever heard?
Oh man, the best story I've ever heard. I've heard them all. I don't know. I can't think of a specific story, but here's another bad landlording. This is a perfect example of how not to landlord. So I had a tenant that moved in from out of state and lived in one of my properties on Kalamazoo Avenue, near Hall, and it wasn't the greatest area. It was one of those properties I had trouble filling sometimes, but so she had lived there for a month or two, and she was on Section 8, so it had been inspected. She's supposed to be in that property and everything. And I said, but she really wanted to get out, and I'm like, I got this house in Wyoming, and she's like, well, can I look at it? And so, of course, again, not having a property management company, I'm 30 minutes away. I'm like, well, all right, yeah, here's the lockbox code. Just go look at it, right? So she goes and looks at it, and then I had to leave. I had to go on a bachelor party in West Virginia. We were whitewater rafting, and I came back, and she had literally moved into this other property. And it was 32 Celia, was that one. And I didn't know what to do. I'm like, what? I told her, I'm like, don't move in, don't do anything, because Section 8 hadn't even approved it.
Wow. But
what a bonehead mistake. Why am I giving out the lockbox code? But I never thought, she would actually just pack everything up.
So was she just squatting there, or was she paying your rent?
Well, that was an issue too. No, I mean, she was kind of paying, but really Section 8 hadn't approved the move. And so they weren't going to pay on that property. And long story short, this is actually, I actually use the RPOA's free legal advice, where you get the 15-minute consultation. I kind of told him what was going on, and I'm like, you think I'm gonna be able to get him out? And this was a crazy story, because he's like, I think you're gonna have to go through the court process, which isn't impossible, but that's gonna take me a couple months to make it all happen. Because I'm like, she has no lease, she's squatting.
You don't even have a lease, yeah.
So I called the Wyoming Police Department, and I told them what was going on, and they said, all right, well, I'll tell you what, we'll meet you over there at this time. And it was a Saturday afternoon. And by this point, the lady herself, she hadn't even been there in a few weeks, but her daughters were living there, and there was another guy. And we actually went up there, and they actually told the people living there, hey, you don't have a lease. And they were in agreement they didn't have a lease. And he had me there with him. And he said, all right, well, I'm going to give you 3 days, and you got to be out of here. And they actually held to that. And then in the meantime, there was one guy that wasn't even on the lease. And all of a sudden I hear this commotion going on, and the police officer's like telling the guy, like, no, sir, I'm not going to help you put your pants on or whatever. I didn't know what was going on, but anytime the police show up at a house, they want identification from everybody, right? And well, apparently there had been a warrant out for this guy's arrest in Lansing, who wasn't my tenant. I'd never even seen the guy before in my life, but all of a sudden he's getting arrested. I had just stepped out to take a call a minute, and he was like in his boxer shorts and stuff yet, and they're arguing about how this guy's going to get his pants on so they can haul him out to the squad car. And that was definitely a moment where I was like, man, what am I doing? How do I get myself into these situations? But you see all kinds of crazy stuff like that. I always allow too many dogs too. I have way too many pit bulls in all my properties. I've had attempted lawsuits over dogs before.
Dogs that have caused some damage,
like hurt the neighbor's dog or something like that.
Okay. So then instead of going after the tenant, they come after you. They
tried, but I actually paid, and this is a funny story too. I actually paid for 2 pit bulls to be put up in the Days Inn in Grand Rapids in the hotel, because I used a lot of the City of Grand Rapids lead program for a while, and the lead program works great if it's a vacant property. It's a little more challenging if it's occupied. But long story short on that, the program will pay to put up the tenants that are living there during the 3 or 4 days that the lead remediation work is being done, but they won't pay for dogs. And so, but I had one tenant who had a couple dogs, and she didn't have any money to put them up, and I had already all the paperwork in. So literally I had to call the Days Inn where they were putting the family up and just give them my credit card and pay for these 2 pit bulls to be housed there for.
Oh my God.
Which they actually did. I didn't realize hotels had separate spots for dogs, but they kept them.
Do they really?
They do. Huh. So yeah, I don't know.
Wow. So the lesson there is don't trust your tenants.
Don't trust your tenants.
Don't trust your tenants with the lockbox code, because they might just move in. And
the lockbox code. Yeah. And another thing I've learned over time too that's very dangerous is if you have a tenant that doesn't contact you in a long time, that's usually a bad thing. On the one hand, you want tenants that are low maintenance, but usually if I look on my spreadsheets that I get from Compass, and if one of them is just looking like a cash cow because the monthly expenses are ridiculously low, and it has been over a series of years, that's usually a bad thing.
Why? What does that indicate?
Well, if nobody's called even for minor maintenance issues, because again, all these houses are older. It's like they all have some type of maintenance issue. It's like having an old car, an old whatever. If you call in no maintenance issues, that probably means you're doing something that you don't want anybody else to see, whether your property is just horrendously filthy, whether you're hoarding stuff, whether you're growing marijuana in the basement, you name it, there's usually something going on. And a lot of times those properties come back in really rough shape down the road.
So what are some true experiences that you've had?
Sure. So one was, and this one was, again, me not taking enough time to, I had bought a house on Dorchester, and these realtors that I bought it from, they were in charge of giving out the cash for keys. And I had this work great a couple times, but I'd be like, well, this tenant that was just there got displaced. Like, they must be looking for somewhere to live. So I'm like, give me their number, and maybe they got another house. Maybe I have another house they can move into. Or in one instance, I actually moved the tenant right back into the same property. Like, they had been booted out, gotten the cash for keys. I bought the home, closed on it. They didn't live anywhere else, and I moved them right back in. And that was a great deal. But in this other one, I had found this lady that had been living on Dorchester and moved her over to this house on Union. And she was Section 8, and we were getting the full rent from Section 8 every month. So the rent was coming in on time all the time. So you don't have a worry there, but she never called, like not once. And eventually, by the time I got the property back, I think she had probably moved out. Oh, I don't know. I would guess 3 or 4 months before we actually got it back and went and lived somewhere else. And she was letting, I don't know if it's family members, random people, just kind of squat or, in the house. And the utilities have been shut off at one point So there was a bathtub that looked like they had been using as a toilet.
Oh,
It was just, it was terrible. And that was another property where I think Emma had talked about going through it, and the mice didn't even seem scared of people. It was just, and
that was a property Emma Persons.
talking
about.
Just they were so used to the filth, and there's just like random guys hanging out and sleeping there, but we didn't know, until we got it back. We didn't really know because we didn't really, I guess in theory I could have gone in at any point with some notice, but as long as the money's coming in each month, it's kind of on your back burner. Usually when the money's not coming.
Too many other problems.
Exactly. There's other projects, but it was disgusting. It was, we found, I got one guy that's kind of willing to do about anything, and he eventually tackled that tub. But, Compass was ready. They didn't want to do nothing. I think they were ready to call like a hazmat team. I'm sure everybody doesn't run into that type of stuff. It depends a little bit what market you're in. I'm sure if you got Class A properties, you don't run into some of this stuff, but
you never know.
You never know. You never know. Right, for sure.
All kinds of people out there. Wow. So I imagine once you switch to third-party management with Compass, they have some sort of regular inspection that they do to make sure that kind of thing is not happening.
Technically, that one was under Compass, but they had inherited a lot of tenants. When we shifted the whole portfolio over, they had inherited a lot of my tenants.
So they were still kind of getting
they were still kind of
of all the properties.
They do, and one thing they do is they do a furnace filter change a few times a year, which is good because I lost a lot of furnaces or parts of furnaces just due to people not changing the filter. But that allows them to get inside the home and take a look at it, and you would get notified if there was something disastrous going on, like what had gone in there. And then there's another, the weird things that happen over time. And this is actually a sad story, but one of my properties I bought actually got run into by a car during a high-speed chase, and the property burnt down, and one of the individuals actually ended up dying. And it was a vacant property because we had bought like 11 properties at a tax sale, which tax sales are another unique kind of thing. But so luckily it was vacant, but it was like a lover, like one lover was chasing the other, and there was a girlfriend involved, and they were going down 28th Street, which, if anybody's familiar with 28th Street, that's normally like a 45-mile-an-hour road. But it was the middle of the night, and she clipped his back end, and he lost control and burned down my house. But
so his car careened into your house, blew up, and burned down the house. Yep. The house was vacant.
The house was vacant, yeah.
But did he die, or did someone else
die?
No,
he died. Yeah, the driver of the vehicle died. His passenger survived. But
wow, so that's an insurance issue then. I can imagine that would have caused you some headache.
It was a big insurance learning for us because obviously. So I always carry insurance on properties basically for what I have into them, because again the whole goal was to be able to hold as many properties as possible for as long as possible. So if I only have $30,000 invested in a property, I'm not going to get replacement cost insurance where it's insured for like $100,000, right? So like on that property, I think I carried like a $25,000 insurance policy and that's through, like we had discussed earlier, through Affinity Group Management, which is a great place to go. If
that's your insurance,
broker. If you're in, and it's all underwritten by Lloyd's of London. But it's all higher deductible stuff. It's not the greatest policy in the world, but it's adequate. But, since there was cars involved, of course, being the greedy people that we are, we're like, well, and this is when I owned with a partner, we thought there might be a good chance that we were going to get like $75,000 or $80,000 for this house that we bought for, I think we paid $12,000 for it, due to somebody's car insurance covering it. Well, as it turned out, both the vehicles were uninsured. And that's not totally uncommon. And hopefully, like LA Insurance isn't a sponsor of your podcast. I don't know. Hopefully not, because
no, I've never heard of it.
That was the like there's certain insurers out there that will insure somebody. They'll insure anybody, but they make you pay like 3 months premium up front, and they charge you a premium about equal to what you'd pay annually, because people will go and get their insurance renewed or their premium paid when they need to renew their driver's license or their license plate or whatever. and then a lot of times they'll let it lapse. So it's not totally uncommon where you run into uninsured people in some of those areas, and that's exactly what happened. You know, so we were trying to track it all around, and eventually just kept hitting a bunch of dead ends. And so, but we got a little bit of money. We got the $25,000 or whatever from our insurer. So it's definitely handy to have the insurance.
Yeah.
But
you didn't. No one thought, well, since this guy died at your property, let's sue the property owner. Nobody thought that.
They didn't. I was a little worried about. They did not, because I mean, people can sue you for any reason, and that's one thing I will say. Some people get nervous about that. I have only been really sued one time, and that's been through a lot of. I've had a lot of turnover, so I've dealt with a lot of different tenants. I've been threatened and been sued probably 4 times, maybe 5, but I've really only had one lawsuit come about, and I'm thankful after that. The way that one turned out, I'm thankful more tenants don't sue me, honestly, because generally, if you get sued, your insurance company is more than likely going to settle it. And that was a strange deal where I actually got sued by Compass Property Management because one of my tenants tried to sue Compass first, and then Compass's insurance company got involved. And when the insurance company gets involved, they kind of have the right to do what they want. But I had literally got home from vacation, and I get this process server that keeps calling me like, hey, I need to serve you this paperwork. So she comes out, and it's this lawsuit from Compass Property Management against MCA Equity Partners, which is me. And I just about shot through the roof. You know, I was like, I was calling Mark Troy, and I'm like, I can't believe you're going to sue me and not even tell me about it. Because at this time, they've grown now, but at that time, I may have been 10% of their total units or whatever. So I was a fairly good sized customer for them. I'm like, I can't believe, but he's like, I didn't know, my insurance company just did it.
So the insurance company had just gone and done it themselves.
Since they're the one liable for the claim, they're the ones who can decide how they want to pursue it. And ultimately, they really shouldn't have been named in the first place. They can be, I guess, but they're really just the management company. I was the owner. But then the same way, my insurance company, and again, Affinity, they hired a lawyer to represent me. And but my lawyer said right from the get-go, she's like, I'm going to tell you, like 95% of the time, these things are going to get settled. Just because, but it's one of those deals where, they have like this ambulance chaser type lawyer. But we all got to go in and do depositions, and it takes time. And then, I think they threw out a number of like 775,000. And then this court panel comes back with like a number like 70,000. And then all parties got to decide whether they want to accept it or not. And if you don't accept it, you actually have to improve your case at trial. Otherwise, you're liable for the expenses of all parties or whatever, improve as far as the judgment. So if you were on my end, you need to get, the judgment reduced. If you didn't, you'd be potentially liable for other expenses, and on their end, they would need to get it raised. But,
wow.
But anyway, so getting sued I think that's a fear that people have, but it really,
it's just a process.
It just happened. Well, yeah. And then, like I said, I've only had it really happen once. So it's not as big of, because sometimes people say like, well, you got to start an LLC for liability reasons. And I think there's numerous good reasons to start an LLC, but at the end of the day, you got to have good enough. If you got good enough insurance, you're going to be okay.
So having good insurance and then having the LLC, those are things that will protect you if that kind of thing happens.
Sure. Because unless you're going to start 10 different LLCs, like all my properties are in the same LLC right now. So there's still assets there to be had. So you got to have insurance in place, because otherwise you're still risking assets to be lost unless you're going to start an LLC for every house, which is a lot of work.
Yeah. And it's not, and not just having insurance on the property, but also having umbrella insurance too can be helpful.
Can be helpful.
That kind of covers you. Covers you over a lot of different things that can happen.
For sure. Sure.
So let's get back to the management part. You have Compass Property Management managing your properties.
Yep.
You've noticed that they're actually paying for themselves because they're getting you more rent.
Yeah.
More, probably quicker turnover, I would guess, or at least better tenants.
Better tenants. They do better. Yeah. I was able to fill them super fast, just not with the right people. So
you fill them very fast.
But yes, less turnover as years go by, for sure. less turnover.
And I would imagine less headache for you because now you're not driving 25 minutes
absolutely.
every time you need to show a property. So how is just
Absolutely. It's much more scalable. I mean, and starting about 3 years ago, I kind of backed out of buying. Like the deals out there weren't quite as great as they were before. And I was just kind of a little bit exhausted with a lot of it. But with what I have in place with them now, it's definitely easier to just think about scale and how big you want to grow it as opposed to thinking about whether you can really handle it or not if it gets too big. It's really, it's just a consistent
you mean
process.
because you have them there, you don't have to worry about scaling. Like you can
I don't have to worry
double your portfolio.
Right. And it really isn't going to be, like right now I handle most of my portfolio via email and via phone, just with them. So I could double the size of my portfolio, and there, it'd just be more emails and more phone calls, that type of thing. So you can kind of focus on trying to find the deals that make sense, trying to find the money to do them, and leaving everything else to
So
them.
what are you doing now? Because you said 3 years ago you kind of slowed down. Are you still picking up properties, or have you moved on to a different type of investing? Because I know you do some hard money lending as well.
Yep, I'd like to get more into hard money lending. We got a few deals going on right now on some flips. So I've been doing some hard money lending. I've been investing with a company called Realty Shares, a decent amount. And I actually got my realtor's license about 6 months ago, and I actually keep that at Compass. So, but I'm actually working on selling off some of my portfolio.
Oh, so you got it so you could sell off your portfolio then.
Yeah, I was and if I get back in the buying market, I kind of just prefer being able to go and do things on my own as opposed to So I'm selling. I'm going to sell my own properties, and obviously I can save some on commissions there if I price them correctly. If you don't price them right, you're not saving anything. But.
So are you selling just to take some money off the table, or because what's the thought process there?
Yeah, I think selling some just to again kind of help reallocate I was in 110% on real estate. I mean, I took everything I had and most of what I didn't. Most of my real estate stuff was all quite leveraged, and a lot of times the cash flow on an annual basis there wasn't a ton. You'd think there's certain years where my gross rents were like $600,000 or whatever, but still by the time when I talk about my type of leverage too, the majority of what I have is all on commercial lending is generally a 15-year amortization. They're not going to give you that 30-year am at 4%. You might get the 4%, but it's a 15-year am. So you're paying down large chunks of principal each year, but it's not like you can pull a ton of cash flow out, especially if you budget for
are you saying that a lot of these single families you are on like some sort of portfolio commercial type loan?
Yep.
Okay, so you don't have the residential loans with the 30-year AM.
No, I got a couple, and that's what I'm trying to.
4% interest. But what you have are portfolio loans.
Portfolio loans.
Which are commercial loans, because what are you packaging, like 10, 20 properties?
Well, it's been a whole range of 10 was probably the most in the early days. Sometimes they would only take like 3 or 4 just kind of as like a token, and then I would pledge other personal assets to it. But it was always a credit line, and then the rate was never fixed for more than like 5 years, so there's a little bit of a credit or a rate risk there should rates start going back up. Where I could be back up to 6 or 7% again in a few years. So, and the market's just good. I mean, the market is kind of where I hoped it would have gotten back to in 2 or 3 years. I mean, if we would have had this discussion in 2012, I would be a lot more concerned about the majority of my properties than I am now. Now I sleep pretty good at night because the market has come back. So I just want to pull some money off the table.
So with these portfolio loans, are you able to peel off one property at a time?
You can. Now, some of them, a lot of what I've been selling are ones that I actually have paid for free and clear. But I have done some other ones where, yes, if I happen to sell off a property, we would swap it out. But every time you're doing that, you're getting rid of one property, I got to pay for the title insurance on the new property and any, work that goes with it. So there's administrative costs there, but you can swap them out. For sure.
And I'd imagine that if you've been on commercial loans and 15-year AM, that means you're paying down your principal much, much faster.
Yeah.
So most of your cash flow then, or well, a lot of the cash flow that you would have in your pocket is actually going toward principal pay down.
It's going towards principal pay down,
which is great when you sell the property.
It's great when you sell the property, yes. But on a yearly basis, it's a little tricky because that principal pay down is still, like you show profit on paper, or you can, but a lot of it, it could be $100,000 of it is principal pay down. And I'm not putting that money in my pocket.
Yeah, the IRS doesn't care.
Yeah, they don't care, right?
Going to the lender.
So I'm still paying taxes on it, so it's like money I don't put in my pocket. So there's just been, I thought when I first started out, I thought there'd be a ton more free cash flow, but it just seems like with most of the stuff, and like I said, a lot of it, I didn't budget properly for capital expenditures. I didn't even view when I was buying houses. I should have looked at them differently.
Well, give me some examples. Like what kind of capital expenditures are you talking about?
Roofs, roof siding, windows. If I could go back and do it again, I'd probably only pick out houses that had vinyl siding and vinyl windows. But I didn't. I would buy anything. But if all of a sudden you get to 50 homes and 25 of them have all that, and the other 25 don't, and let's say you can get it done for 10,000, which you probably can't. But I didn't for those 25 that don't. I didn't have 250,000 budgeted to set aside to do that. And then so you're always kind of, and I never went back and really refinance these properties for the most part. So
you put the money into them. It would just be out of pocket.
Out of pocket, right? So all my cash flow really was getting sucked up by capital expenditures. Which I suppose I probably could have tried to figure out different ways to refinance them. But yeah, it's not like when I put that $10,000 roof on that I'm all of a sudden getting that amortized over 15 or 30 years.
That's
it's just
out
coming
of
out
your
of
pocket.
Yeah.
Well, that's great for the long term.
It's great for the long term.
These properties forever because you're improving them. You're
right.
building up all this equity. You're just not realizing that equity
Correct.
until you sell or do a cash out refi.
Correct. That's why because I'll hear a lot of people. I personally haven't found the magic formula to how you can live just off real estate, doing it the way I did it, just because, there's a lot of principal pay down, a lot of property improvement, but not really a whole lot of cash flow coming out of it until now. I mean, now that I'm selling, I'm getting some really nice chunks. But I think James Loftus or somebody had mentioned, if you really want to figure out whether you can live just off your real estate, you got to first figure out how little you can live on. Because you don't want to get to the point where you can't really do what needs to be done on a property because you need to take the family on a vacation or something like that. It's just really hard to budget, when some of those bigger items are going to come due. And I think, like I said, a lot of them come due with the single family rental inspection that the city of Grand Rapids now has that they didn't back when I started doing this whole gig. So
yeah, ideally you want your rental property to be self-sustaining.
Right.
Meaning you don't have to take money out of your personal finances to put into your residential. Now that happens, and I know I've certainly put enough of my own money into some properties, especially in the beginning. But you want it to become self-sustaining. Now, you brought up a couple of things. It sounds like you're at the point now where if you sell off some of these properties, you can really realize the profit.
Yeah, I've been really lucky. So yeah, I mean, just again as an example of one deal, I just sold a house on the corner of Paris and Franklin, and again, when I bought these houses, wasn't the greatest area, and I bought that house for $16,000. And one of the only reasons I bought it is because I was kind of in a cash. At one point, that was another house that was owned by Macatawa Bank. Well, if they were selling me their own houses, then they were willing to finance them. So I would come in. Otherwise, they couldn't give me money.
So you were able to finance a $16,000?
Yeah. Usually it would be in groups of 3 or something.
Okay, so
but yeah, literally. So if I came in with 20 or 30% down, and if it was their property, they would finance it. So it was a way for me to acquire properties and find some more financing. So it might have not been the best deal on the market, but what's been lucky for me is how some of those areas have shifted, and that area has gotten a lot better. The dynamics of the area, I don't know if you call it gentrification or what you want to say, but you just have all different types of people. It's not just low income, it's not just whatever, and it's getting closer to that wealthy street corridor, which is improving immensely, heading towards East Town and East Grand
all the
Rapids.
development and all the growth of the downtown area is really pushing out, and it's really changing the boundaries of what
Right, it is.
what it used to be.
It is. And so, I actually sold this house off on land contract, trying to avoid some of the single family rental inspections in like 2012, I think. And then the lady that bought it just couldn't afford it. I think I sold on land contract for like $55,000 in 2011, maybe. Because that's kind of what
So
the
you
market.
picked it up for 19.
I picked it up for 16.
16.
It was rented at the time. It was low. It was like $600 a month, but it was a good sized home. But the rents were really low. I mean, in today's market, that would probably rent for between $1,000 to $1,100. But so I picked it up for 16. The lady actually that lived there ended up moving into another one of my properties because her Section 8 voucher changed and she needed a smaller property. But I put some money into it. I mean, I probably put $8,000 into it over the time that I owned. Well, I did a roof, so maybe add on another $6,000 for that. So maybe $14,000 over the time I owned it. But there's quite a bit of rent coming in as well. Sold it off to try to avoid some other deferred maintenance that was going to be coming up that the single family rental inspection would nail. And then fortunately for me, but unfortunately for her, she couldn't afford it and turned the house back over to me about 3 years ago. And then somebody had just moved out. And so, again, anything crazy, we put new carpet in it, repainted it, and, we'll go to like Lowe's and buy the cheapest white cabinets we can find. Usually there's a certain style that I like, but usually it's the low end cabinet. So I put maybe $5,000 into it again. And then, had it on the market for like a week and sold it for 102.
Wow. Not
so
bad.
So that was, it's been really, I'm kind of shocked actually that I never thought that I would get that, for that property in those areas. And there's other ones in Wyoming that I thought I would maybe get more for, but it's like the Grand Rapids ones are seeming to get higher sales prices right now than the Wyoming. So
yeah. Wyoming's great for rentals.
It is great.
Definitely,
Yes.
like there's a lot of, the occupancy is very, very high.
It's very high and you get better tenants. It's just that, the prices
appreciation hasn't.
Yeah, because and yeah, it's just not like there's certain parts of Grand Rapids that are just kind of like a cool place to live right now. Like I had some houses on Bemis. I don't know if you know where Bemis is, or Baxter, Sigsbee. These were like we would do anything to keep tenants in there. Like we didn't want to lose them because 5 years ago it was hard to fill them. And then the neighborhoods were rough, and now I mean the neighborhoods are still maybe a little iffy. But you have total different, you have college kids living there or just young.
Yeah, a lot of the younger people are
like hipster dudes.
Yeah, they
just,
want to be in the, they want that, the mixture,
and it's been great. But yeah, so the idea is to kind of try to sell a bunch of them off. I think I'd like to get down to about 30 homes, and maybe hopefully by then own those free and clear. But it's taken a lot longer to, even though we're doing fairly small rehabs yet, what used to take us 2 weeks now takes about 2 months because I just don't have the guys working for me that I once did. And everybody's been, back then it was so, I would find people just by word of mouth. Whereas now the people that are still in the construction industry, they're busy, building is booming around here again. And you kind of got to get on a list and wait. You don't just have people lining up to work. So it's a slow process. It was a lot faster buying these so far than it has been selling them.
So is that your magic formula now? I mean, it sounds like you want to get 30 of them free and clear, paid off free and clear. Yeah. And that cash flow would that then be your magic formula?
Maybe sit on those
to being able to retire on real estate.
Yeah, maybe. I don't know. I'm not really sure. I'm just kind of going at it, but that in my head, again, for no particular reason, that feels like a little more it's kind of where I'd like to get down to. But ultimately, I may sell them all off. I don't know. I think there's other ways to make returns on your money too, such as realty shares or getting in with other guys like you that do syndication deals or So
more passive investing.
Yeah, I've definitely, yes.
So what
I've definitely become more passive. Whether I got burnt out or what, but yeah.
You've done your time in the trenches. Now it's time to let other people make some money for you. What is realty shares? You've mentioned that a couple of times, and I know I've heard of it. What is that?
Sure. Well, it's basically like hard money lending, sort of, but it's like crowdfunding. So realty shares might pledge $1 million for this apartment building that somebody's acquiring, and they're going to reposition and then ultimately get it refinanced out. But you can buy in increments, and every deal is different. Realty Mogul's another website, but you can buy in increments of $5,000 to $10,000 usually. So for example, let's say you had $100,000 to invest. If you can find all $5,000 investments, you may be able to spread that over 20 different properties. So you get some diversification there. And the returns are still kind of more closer to hard money rates, like anywhere from 9 to 12%. And some of them are straight loans. Some are kind of equity. The only thing is, so far every deal has gone fine, but at some point, if the market flattens out again, some of these deals may not go so great. And
you're riding the trend of a market think, that's moving up.
Yeah.
Right now.
I mean, I think at some point I may get burned on a couple of those deals. I'm just guessing.
Because there's always risk.
There's always risk.
No matter
exactly
what portal you invest through or who you invest with, there's always risk in real estate investing.
For sure.
It's no different than investing in the stock market.
Yeah, exactly.
I tend to think it's less risky than investing in the stock market, but there's always risk. So But it sounds like you've got a track record, a positive track record.
So yes, so far so good. And if one of the deals were one to go bad, I'm not sure how that would sort out, because these deals are usually all separate LLCs, but you might have 1,000 people that are all members of that LLC. Whereas if I'm hard money lending, like for example, we have a $500,000 flip going on in Spring Lake right now. Should that go bad, I mean, I have, or my partner and I have a mortgage on that property where we could reclaim that particular property.
So it's backed up by the asset.
It's backed up by a mortgage, right? Whereas, I don't know how you...
how do you...
A distressed asset when you have 1,000 owners, I don't know how that's going to work.
Is that 1,000 fractional shares of the
asset?
Yeah,
kind of something, I guess, but how they decide who disposes of it. I mean, it's kind of like the same way in the mortgage crisis when, a lot of the properties that I was buying were owned by... a group of investors that own mortgage-backed securities. Everybody's all in these pools, and then it was crazy. It was a crazy time. Then they have asset managers just getting rid of these things. But so you have a little less control, but it allows a great amount of diversification without huge amounts of money. So it's an option for sure.
And so far, you've been seeing double-digit returns?
So far. And then, and you can go there to get your deal funded too. I haven't. I don't have any deals to really work on, but that's the other side of realty shares is people going there to get financing for their deals.
What do you prefer, realty shares or doing the hard money?
Right now, realty shares until I get burned once or twice. Then probably hard money. I mean, realty shares is pretty simple. It takes care of itself. It's a very passive, and again, you can diversify, so you don't have such a big chunk stuck into one project that may or may not work. But
now, Realty Shares is a crowdfunding platform.
Yeah.
How do they vet you? I mean, how do they know that you're sophisticated enough to make these types of investments?
Right. Yeah. Technically, well, you have to be an accredited investor. However, they just started. I think a lot of those laws will change. I mean, right now, an accredited investor, I believe, you have to make either $200K annually or $300, or at least have $1 million.
Yeah, accredited investor.
Yeah, your deals probably have accredited investor, right?
Yeah. That's when I syndicated. It's only accredited investors that I work with. Accredited investor either makes $200,000 a year over the past couple of years, or with their spouse or partner makes $300,000 a year, or they have $1 million in net worth, not including the value of their home.
Prime, yeah.
Let's go back a little bit, because you mentioned the home inspection program. And what was it, back in 2013, I think, that the city of Grand Rapids decided to start doing home inspections, city inspections on single-family rentals. And that's kind of changed the game a little bit, because it's created a lot more cost to owning single family rentals in Grand Rapids. Can you talk about that a little bit?
For sure. Yeah. In the beginning, all my 2 units would be inspected, but my single families, none of them had inspections other than every year, if you had Section 8 tenants, you'd be getting an annual Section 8 inspection. So the city, because so many homes that previously were owner occupied started getting turned into rentals during the crisis, started to push for this inspection program. And actually the RPOA, I'm not very active in the RPOA, but they fought it fairly hard because obviously it's going to make an impact on most landlords, but it still got passed through. And so at the time I kind of just usually try to roll with whatever happens. So it is what it is, and I got to figure out a way to do it, but I didn't realize exactly how expensive it was going to get. So they do all these initial inspections, and some of these properties like hadn't been inspected in maybe 5 years or whatever. Cause like I was always about speed, like getting them up and running. I didn't do a lot of the deferred maintenance right up front. And you'll hear other guys that rehab and say, I want to make this house just like my own. I'm going to do all this stuff to it. Well, I knew how trash some of these homes could get no matter how nice you made them. So I was more like, clean it up, make it look pretty good, and go from there. But so they started doing these single family home inspections, and, some of the average thing, it would range from needing new electrical service to replumbing some certain things to if the countertop was a little bit chipped up or something, they'd say, hey, I want a new countertop here.
So the home inspectors would be pointing these things out.
Yeah, it'd be on their list. You get a list, and the shortest list I ever had was like 10 things probably, but the longest list is 50, and the average is probably in the 30s somewhere. And some are small items. Some might be like, the windows aren't staying up on their own. They need to be pinned. But then other things would be, the house, the paint is peeling on the house. So you need to get it fixed. So, well, do you spend the $5,000 to repaint the whole house, or do you spend the $8,000 to do the siding?
But either way, you're spending thousands.
You're spending thousands. And in the long run, like a lot of this is deferred maintenance that it's going to need to get tackled at some point. And the same way with roofs, it'd be like some shingles are missing here on this side of the roof, but do you want to just try to patch that up, even though the whole roof maybe only has a year or two to go, but it's never leaked. So you just go ahead and spend the $10,000 on the new roof. And it's just been more extensive. It's been, when you're looking at a portfolio of 50 homes or 80 or whatever the number is, when you start putting those numbers together, spread them out of that many homes, it can be really expensive. Now there's some that I'll get away for. I would say the cheapest usually is $2,000. I had to put a new driveway in. I didn't even know they could force me to do that. But if it looked like there used to be a hard surface there at one point, they can force you to put a driveway in. Even though this driveway's been gravel for the whole time I've owned it. If I had the same tenant, they don't care. So it's like you're spending all this money and not really getting any return in your rent immediately. Maybe down the road you do. And I don't know about other landlords, but I think ultimately it's going to kind of push some of these away from being rentals, because I think people may look to sell them off because of all the expenses they've incurred, or they're going to ultimately try to raise the rent to get the money back out of it. So it's been a battle. And I said, that's one thing Compass helped me out with too. And thankfully the city agreed. They were willing to put me on a schedule of one a month eventually. Because in the beginning, I had like 70 houses to get certified, and 3 or 4 would show up a month. Well, again, with my strategy,
that could put you out of business.
Oh my gosh. Quickly. Yeah. I was like, especially when I'm trying to pay stuff out of cash flow, it just was totally shifting things. But it seems like there's been a lot of things in real estate investing where I always feel like I'm turning the corner. I had that same thing with that apartment building on Taft. I always felt like I was going to turn the corner of that thing, and then something comes up that just zaps your cash flow. And a lot of that's probably from how I went into it initially. But it really, until I start selling assets, like when I sold that apartment building, like that's the only time I've realized serious cash gains. It just seems like otherwise there's always something.
Always
you get done with one thing,
some new expense.
Yeah, and even now, like I just finally got finished. I have a couple houses to do yet that haven't ever been inspected. because they did allow me to do one per month. But I have other ones. A lot of these I think the original certifications I did were usually 4-year certs, and some of those are now coming due. So I'm just getting done with the first round, and I already got the second round coming due.
Cycle is going to start up.
Yeah, and hopefully, from what I've heard, talking to Compass, I'm thinking the second round won't be as bad as the first because you've tackled a lot of the major stuff. But I don't know. It's just one of those things.
Well, it seems to me that the areas that you're buying in and the types of properties you've described, you're basically buying in C, sometimes D neighborhoods.
For sure.
And when you have these inspections, they can be helpful. Yeah, there's no doubt about it.
Yep.
The inspections can be necessary and helpful. However, there's an unintended consequence, which is if they're costing you all this additional money in order to bring it up to a certain standard that might be more appropriate in a B neighborhood, then what does that do to the rents and the affordability,
right? Exactly,
and the availability of the type of properties that you're offering,
right? Because you need low income housing. I mean, as much as some people want to be called slumlords or whatever, there's a definite need for low income housing out there, and yeah, you're kind of raising the bar, and and I said, like I said, as long as they kind of keep it consistent, if it makes the whole neighborhood better, that's probably going to help my resale. That doesn't help low income housing though.
Or affordable housing.
Or affordable housing.
Which is a real issue in Grand Rapids now.
And it is now,
people are getting pushed out of these neighborhoods because maybe it doesn't make sense to have them as rentals anymore, so you're selling them to homeowners.
Right.
B, you're putting so much money back into them that you have to raise the rents to be able to afford that.
Right. You certainly want to. Yeah.
So what is it? So what is it? So that's my question.
Yeah.
What does it do to affordable housing?
I mean, I guess I don't know. I mean, I think right now it's not helping it because the market in general has recovered, and you can unload these properties if you want to. If it hadn't recovered, it would make the stock of affordable. I mean, maybe the rents would have still stayed low, and it could still be affordable, even though just because the market was dictating it. But right now, I would say it has hurt it. I mean, right now for sure, because the rents, like I said, keep going up. I have a lot less Section 8 tenants now than I did originally too, in part just because
a lot less.
I have a lot less than when I started. Yeah, because there's more people looking to get close to the inner cities. The more the metro areas, and so that has pushed up rent along with other factors, and that's actually kind of helping me on selling houses even because, that house I sold for $100,000. If they can get a loan at 4%, you're probably looking at a payment of like $500 a month, maybe, or something. Put taxes and insurance in there, maybe you're at $600 and something.
Still under what you would.
You're still under the $1,100 that you're going to rent it for, right?
Absolutely.
And so I think that's spurring a lot of people to buy because they're getting sick of paying that rent. But yeah, the rent, it is. I mean, it's been great, but I've really been surprised over the last couple of years how the rent has shot up. But you're right, like where the true affordable housing is, I don't know. Now maybe once they keep putting more and more projects online in Grand Rapids area, maybe if we get to a point where there's a glut, maybe the prices will go back down. But most of the stuff that they're putting up isn't really affordable housing either.
No, it's A-class.
It's, right. It's
developments going up, which are commanding the much higher rents. The top of the spectrum type rents.
Right. Yeah. So I don't know. I guess
it's an interesting conundrum. I always look at that and I'm like, on one hand, there's all this great development going on.
Yeah.
But it's squeezing out the affordable housing.
Right.
And it's valuable to have investors and owners like you who provide that affordable housing in those neighborhoods. And I think there has to be some give and take there between what your needs are and what the city's needs are.
Yeah.
In order to keep that affordable housing available.
Right. And maybe it'll even out. I mean, Grand Rapids, and this is one of the things, one of the other things when I first started buying properties, I was like, I thought Grand Rapids had a lot of stuff going for it. And it's definitely played out that way. I mean, it's kind of goofy that every other building in the city has Van Andel or DeVos's name on it, but they've made huge investments into Grand Rapids, right?
I mean, they've sculpted a city that is fantastic.
And their investment has spurred other investment. And when the crisis hit in like 2008. I mean, I was buying houses in Grand Rapids that before you could only pick up houses like that cheap, like it would be like Detroit, or really like closer to our area, it would be Muskegon Heights. Like you could have bought houses in Muskegon Heights 15 years ago for $10,000 or $20,000. In Grand Rapids,
you can still buy them for
you still, yeah. I've heard your podcast with Kathy,
Heights,
and that was, Muskegon's like an hour away from me, and I'd been through there, and I just didn't feel as comfortable with it. Whereas Grand Rapids is closer, but I'm like, man, if I can buy a house in Grand Rapids for what you used to only be able to find these in Muskegon, like this, like Grand Rapids has so many things going for it, and Grand Rapids isn't Detroit. It doesn't have as many rough or bad areas in it. And then I'm surprised. I didn't think Grand Rapids was gonna boom as much as it has. I just had a good feeling that it wasn't going to decay or deteriorate the way maybe some other areas are that don't have as strong of, like manufacturing job base and as strong of investment from individuals. Like I said, yeah, they've. It's kind of weird that how everything has a DeVos or Van Andel name on it, but they've pumped tons of money into the city to help it be what it is today.
Yeah, and there's a very strong private public partnership between the companies and the corporations and the people like the DeVosses and the
not just them. You got the Meyer, whoever, right?
Yeah, I mean, there's so many names out there, and they've really like put a lot back into this community. And I think you and I both, in 2008 up until now, have had high expectations. Like we thought, okay, this is a good area, this is a growing area, but what's happened has just exceeded anything I ever imagined.
Yeah. No, it has for sure. Like I said, some of the prices in some of the areas right now. I mean, but it wasn't like there was a crazy bubble. It wasn't like we were California or wherever. I mean, it wasn't like there was a huge run up in housing prices, but I'm surprised. Actually, and the other thing too, like with the Class C and D properties like I had, they were kind of the last ones to come up with the rest of the rising ship, so to speak. Like a lot of the suburbs of Grand Rapids, if you're you can put your $250,000 house in the market and it's just selling in days because there's just not enough out there for the amount of people that can qualify for that loan. Well, my properties, I mean, a lot of the people that can qualify for these homes are the people that lost them into foreclosure in the first place. So they're not financeable for a while. And then lending restrictions were so tight. Like it really, for the bottom properties, they didn't really come up, I wouldn't say until it felt to me like the last 2 years for sure. They didn't. They're kind of the last ones to see the.
But you're seeing it now.
I am seeing it now. Yep. And like I said, that has a lot to do with just the dynamics of the city and areas that luckily have changed a lot. And when I first started buying, there's a lot of people that didn't want anything to do with the southeast side of Grand Rapids. And so by default, that's where a lot of the cheapest properties were, and I was buying the cheapest things I could find. And so hopefully that continues. I don't know. Hopefully I can, like I said, hopefully I can unload enough of them before there's another downturn, but I don't know. I don't know when that'll be. You hear some people talking about, well, I had one guy ask me, he's like, well, are you getting positioned for the next downturn? And I mean, that would be great. I mean, on the one, I guess from a personal standpoint, if I could go to sell a lot of these off, get a lot of cash, and then, be able to capitalize on another downturn. But I don't know. I mean, people speculate something's going to happen, but like I said, really for the first, all of my lifetime up until 2008, I had never seen property prices drop in our market, and so to say that it's going to happen again in the next 5 or 10 years, I mean, who knows? I don't think we've seen anything like 2008 since, I don't know, Great Depression or,
That was definitely kind of a shock to a lot of people. Yeah, it's interesting. I mean, I tend to think there's going to be a downturn in the next 6 months, a couple of years. But what that's going to look like in each area is completely different. I think Grand Rapids is definitely poised to weather a downturn much better than other areas that are in
like a San Francisco, where you get the huge price, right?
Yeah. Which are, if you listen to my Kathy Fetke interview,
I did.
I mean, that's things. It's just unaffordable there,
right?
So anyway, as we wrap it up, what advice do you have for people who are looking to get started in investing?
I mean, I think the main thing is just to get started. I mean, and again, you don't want to go buy bad properties, but you learn so much from the first one you have. So as long as you can buy a property and not bankrupt yourself with it, worst case, always look at the worst case scenario, and we'll assume that's highly unlikely that's going to happen. Just get you started and do something. But definitely if you can eye something that, maybe look at it from a deferred maintenance standpoint. If you can buy a house with nice siding, nice windows, a roof that has some life on it, that can go a long ways. But if that's not there, I think, and then again, I would vouch for Compass Property Management. If you can find a good property manager right out of the get-go, I would do that also.
Yeah, finding the right property management company is key.
Right. And then I think, try not to take things personally too. Like a lot of people are always like, well, doesn't that bug you not collecting, rent money or having to chase that money down? And to some extent it does, but I think some people tend to take that personally. And I'm looking at it like, in my truck parts business, we have Fortune 500 companies that we deal with that say, all right, we're going to pay you in 87 days, take it or leave it type of, like in any business, you're chasing money down. You're chasing money down from huge corporations. So just, you got to be aware of some of the hassles, such as, people aren't going to be banging on your door generally on the first, wanting to pay you the rent. Now you're going to run into hopefully some of that, but it's just something you got to work at a little bit and just kind of know that that's going to be one of the things. But
if you have Compass or a good third party management company, they're doing that for you.
It takes some,
and they've got it on the schedule, and they will make sure that the people are paying you on time.
Right. And it takes some of the frustration out of it, because I have another lady that I know, and she just was managing her own property that she had moved out of. And, but she just gets so frustrated every month over, like, oh, I got this text message saying they're going to pay, and then they don't pay. And, just things like that. And definitely, again, I'm not super active in the RPOA, but they have tons of, good classes, and you can get all the forms you need there. Again, they have the legal advice thing I was talking about. And do you teach class there at all? Or
I actually teach an advanced financial analysis course for the RPOA.
Okay.
Yeah, they have. Thanks for bringing them up. They have excellent courses and materials and just support for rental property owners and investors. Right.
Like I think I just read yesterday, they finally got, the RPOA had worked with the city. Now the city is going to allow water to be turned on at properties that are condemned, which I had a personal experience with that because I had taken a house back on land contract. And in the meantime, the lady that had bought it for me rented it out. There was this huge problem with power going out to the house. Anyways, the city condemns the property. Well, eventually I take back the land contract. Well, if you have a condemned property, they will not turn the water back on until you're done with their list of 30 things, right? Well, some of that's pretty hard to accomplish if you don't have any running water. Now, they don't want the water on because they don't want you to try to bypass them and move somebody back into that house. So just things like that, that's something that the RPOA does, and it really does help, because simple things like that. I think the sidewalk inspections was another one that they kept pushing. It used to be in the city of Grand Rapids, you had to have a sidewalk inspected by the city and cleared before any property could sell. And you still have to have the inspection, but it's changed a little bit. It's not quite as much of a nuisance as it used to be in getting a sale to close.
Yeah, it's not as onerous as it used to be.
Right.
Yeah, that's one of the great benefits of the RPOA, that people, they don't get it directly, but they do get it in their bottom line.
That's some of what your dues go for.
Yeah,
sure.
They work very closely with the city. They work very closely with the state to work on whatever legislation is out there regarding rental properties, and whatever rules or city regulations are out there that are hurting rental property owners. So you just gave two great examples.
Yeah, and even like the Voice magazine that they have, that's been a good asset for me. That's where I found Affinity Group Management, who's my main insurer now. I've actually way back I remember the Coutiers used to advertise in there about doing tax appeals, and because my properties were assessed considerably higher than what I paid for them, so that was a huge process. But that has saved me thousands and thousands as the years go by, appealing all my taxes, and the Coutiers helped me with that. But so just things like that, even from just looking through that magazine every month, it'll point you to some contractors that are used to, dealing with rental properties or lawyers that are used to dealing with evictions, like kind of point you towards people that are working in the industry that you're dealing with, being a landlord. So
yeah. So to find out more, go to rpoaonline.org, because it's definitely a worthwhile group to be part of. Well, Andy, thanks so much for taking the time to talk with me today. I mean, it's great sharing all your experiences and a lot of your experiences I've had as well. So it's interesting for me to listen to what you've been through. And I'm glad you're selling off some of those properties, finally realizing the money that's been building up all this time. And I wish you the best of luck.
Thanks. Yeah. Right now the market's pretty good. So if we'd had this conversation 4 years ago, it might have been a lot different.
Might have been a little more depressing.
Yeah, a little more depressing. But right now I'm pretty upbeat about it. So
fantastic.
Thanks for having me.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.